Hello, everyone. It's good to have you around with us in another interesting episode of our financial literacy sessions on TWI. So, today we're going to be examining a very interesting topic, and it is entitled Understanding Risk Management in Investing. Understanding risk management in investing. Investing is allocating financial resources towards a particular venture with the view or with the aim of getting profit in return. That is what investing is. Risk management, on the other hand, is the process of identifying, assessing, and mitigating any potential losses or to make sure that an investment window achieves sufficient profit at the end of the day. So when we talk about risk management, we're looking at how to ensure that we reduce losses and maximize returns, because they are mutually exclusive. If your returns are going up, then your losses are going down. If your losses are going up, then your returns are coming down, and vice versa. So we're looking at how best to handle risks in investing. It was Robert Kiyosaki that said that investments are not risky, and what is risky are the investors. That statement is not absolute, but it has a lot of truth to it. As an investor myself, I've also found out that the more knowledgeable an investor is in the investment he's going to do, the less risky the venture becomes. So if you are very knowledgeable about stocks, you're very knowledgeable about how companies operate, how the boards are constituted, how monies are moved around in a company, how companies gain their value, how their share prices appreciate or depreciate. If you understand the workings of the capital market, then investing in stocks will not be as risky for you as someone who doesn't have any ideas. Okay, so it's important to always remember the quote by Robert Kiyosaki that the investment is as risky as the investor. So we want to now dive right into the strategies that we employ in ensuring that our risks are low in investment so that our returns can be maximal. Our risk will be low and then our returns can be maximal. The first strategy we want to look at today is the strategy called diversification. Diversification. It's a very popular balance when it comes to investing, because you hear very experienced investors talk about having a diversified portfolio. Okay, so diversification simply means putting your financial resources in different asset classes. Okay, so let's assume you have ₦1 million to invest. Diversification means not taking the 1 million naira and putting everything in stocks. Okay, not taking the entire money and putting it in one instrument. So diversification will look like, if you have capital of 1 million to invest, diversification will look like this: maybe 300,000 in stocks, 200,000 in bonds, another 300,000 in mutual funds, and like that and like that. Okay. So that's essentially what diversification is about. So diversification can also happen in other ways. For someone who is investing in the stock market, diversification can also mean investing in different sectors of the stock market. So instead of taking your 1 million naira and putting everything in the banking sector, okay, you can take 300,000, put it in bank stocks. For instance, the banks are all declaring massive profits. Zenith Bank declared over 1 trillion. GT declared over 1 trillion. Fidelity declared close to 300 billion. It's unprecedented. They are paying dividends of that Zenith is paying 4 naira per share. Guarantee is paying like almost 8 naira per share. Fidelity is paying a little over 1 naira per share. So the banking sector looks very attractive. So diversification in that sense would mean taking your funds and spreading it out instead of putting everything in one bank. Diversification could come by way of putting some of that money in GT, putting some of that money in Zenith, putting some of that money in Fidelity, putting some of that money in other banks. That's if you want to stay in that particular niche of the stock market. You could also play out by saying you put a certain amount of it in the banking sector, put some of it in industrial goods. Boa Foods declared very good profits recently. So you can put in the fast moving consumer goods segment, or industrial goods like we call them segment, and then putting some maybe in insurance, putting some in real estate. That's another very good place to invest right now in the Nigerian stock market. So that's as far as diversification is concerned. I believe that is very well understood. The second thing that investors do to manage their risks in investment is to do proper asset allocation. It's closely related to diversification, but it's slightly different. So, knowing which instruments to invest or put more money in. So, let me give you an example. You have 1 million, or you have 2 million, or you have 5 million to invest, or you have 100,000 naira to invest. Okay, knowing which particular asset class to allocate more resources to is one way to reduce your risk. Okay, let me say a few things to try to explain that. If you have watched some of our videos, there's a video, I think our very first video on the investment and investors masterclass. We give a very detailed explanation of some of these things. You might want to look up that video after now. It gives a more detailed view. But let me just pick a few things from that video that we shared. There are fixed income instruments like bonds, commercial papers. So you might want to say, okay, I'm allocating more resources to fixed income instruments rather than stocks and equities. Why? Because stocks are riskier. They are more volatile. They are more prone to fluctuations. So if your risk tolerance is not very good, you might want to allocate more resources to guaranteed return instruments, and then allocating less resources to seemingly more volatile instruments. I think that makes sense. The next important thing that we need to talk about in managing risk and understanding risk in investing is to understand the concept of risk tolerance. There is a concept of risk tolerance or risk aversion. What is risk tolerance? The amount of risk you are willing to take in order to gain very huge financial returns. Some people have very low risk appetite. Some have very high risk appetite. And research has shown that younger people tend to be more risk tolerant than older people, than retirees, for instance, who feel they have a few years to stay and want to make sure that their incomes come back the way they want it and the way they expect it to come. Of course, there are exceptions to every rule. So your risk tolerance will largely determine how you invest in the market. And learning and knowledge helps to increase your risk tolerance. Okay, just like I said when I started, I quoted Robert Kiyosaki. The more knowledgeable you are about an investment instrument, the more tolerant you are about taking the risk. So good investors increase their risk tolerance by increasing knowledge about the investment instruments that they intend to invest in. Okay, the last thing I'll say about managing risk in investing is a concept called hedging. All right, in the US and in most developed economies, you have what is called hedge funds. We don't have a lot of that here in this part of the world, but the principle still holds true in this part of the world. Okay, so we usually recommend, and I practice that, always hedge your investment with an investment that is very, very secure. Let me give you an example of what I'm saying. You want to invest, for instance, maybe you have a total sum of 5 million to invest, and you want to invest maybe 2 million in capital market instruments, the ones I mentioned earlier. It is recommended that you take part of that money and invest it in real estate, even if it's just a piece of property, a piece of land you buy. Of course, in a good location, in a location that has potential for capital appreciation. Whatever happens with your investments in the stock market or in the capital market, you can be sure that the returns on the real estate investment you do will compensate for any losses that you would accumulate investing in the capital market. So let's say you have 5 million to invest. Look for a place and get a property for maybe 3 million, 3.5 million, and then invest the rest in any of these other instruments. You are likely, and you are most, in fact, you are very, very sure that that investment in real estate will certainly compensate for any loss you will accrue from the stock market. So that's the principle of hedging. So it's like an insurance, if I'll use that word. It hedges, a hedge is like a fence, a defense, a wall of protection. So these are some of the things around risk management in investing. So I would say the last comments by asking you to go and read. Recently, a young man came to me and said he wanted me to mentor him on how to become a very successful investor. And the first assignment I gave him was to go study all the investment instruments. Go study them. So your greatest resource, your greatest mitigation, your greatest risk mitigation strategy in investing is to acquire knowledge. So go and read, go and study, get books on financial literacy. There is a web page I would like to recommend. Very, very good web page. Nairametrics. It's an online blog that offers a lot of financial literacy. Go online, check Nairametrics. They have a lot of beautiful articles that will sharpen your knowledge of the capital market, sharpen your knowledge of the different investment instruments, and will make you a very, very savvy investor. So on that note, I'd like to thank you for spending time with us. And in case you watch this content and you're yet to subscribe to our channel, I would appreciate it if you subscribe to our channel, hit the like button, share this video with your friends, loved ones, associates, people that you know need to start investing, and people that are afraid to invest. I would like to do like a quiz right now. So having said all that we have shared concerning investments and risks and all of that, I'd like to know which between stocks and bonds, which between the two do you feel safest investing in? Which do you feel safer, or which are you more comfortable investing in? Are you more comfortable investing in stocks? Are you more comfortable investing in bonds? Please, I'll be glad to see your comments, your answers in the comment section. Please tell us which of these two instruments you're more comfortable investing in, whether it is stocks or bonds. I meet a lot of people who say, I have money in the bank, but I'm afraid to invest. I don't trust the bank. I met a very big man sometime last year, and he said he's a very successful businessman, but he never invests in the stock market because, according to him, he doesn't trust the executives of the companies. He feels they use the monies from shareholders to live very lavish lifestyles, which is largely not true. Of course, we know there are abuses, but that's why there's an oversight function for the SEC, Securities and Exchange Commission, oversighting the operations of the different corporations that are listed in the NGX. Of course, the NGX as a body, it's a public quoted company, also regulates the services of all the companies. So on that note, I would like to tell you goodbye, and please drop your comments, drop your questions in the comment section, and thank you for always being a part of what we do. So until next time, have a wonderful time. Bye for now.